I'm MC Laubscher, and you're listening to the Passive Investor Show.
The views and opinions provided on this show are for informational purposes only and should not be misinterpreted as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, please go to passiveinvestorshow.com.
And now, the Passive Investor Show.
Welcome, PI
Here's your
listeners,
host,
to the Passive
John
Investor
Fortes.
Show. I'm the Passive Investor Consultant, John Fortes, your host of the only ranked podcast for passive investors in multifamily syndications and real estate funds. Our goal and purpose of this show is to be a resource to investors and help them master their passive investments by beating inflation 1% at a time. My guest today is the legendary MC Laubscher. MC is the creator and host of the Cashflow Ninja and Cashflow Investing Secrets podcast and president and chief executive officer at Producers Wealth, a virtual wealth creation firm that assists investors and business owners to set up and implement infinite banking. MC, thank you for coming on the show.
Thank you so much for having me. Excited to be here.
Awesome, man. Can you tell us about your background and how you got into doing what you do?
Yeah, so I'm originally from South Africa. So I grew up in South Africa during a very interesting time, which turned me into a critical thinker that is not only curious, but always basically research everything and try to get down to the bottom of everything and the truth. And on my journey, I played a lot of sports, and that's how I actually ended up in the United States. And just as with everything else that I was researching, because I loved history and economics, my mom actually gave me a purple book that said Rich Dad, Poor Dad, which she said, I would find interesting. And I surely did. And it took me down the rabbit hole of what money is, how money works, what's the difference between the ultra wealthy and how they manage money, where they put their money and how they invest, and in contrast with what the average person's doing. And then I kind of just researched as much as I possibly could about money, trying to understand it because it basically is at the center of everything that we do. People say it's not important, but try to eat without that. Try to provide shelter for your family. Try to clothe them. Try to get your family the medical care that they need. You name it. Everything is tied to it, right? So I thought, it's pretty important to understand what it is. If this is the one thing that keeps everyone on a hamster wheel. So I really deep dive into that, studied research, studied for the past 2 decades, the most successful folks, entrepreneurs, business owners, investors. I became a real estate investor shortly after reading Rich Dad, Poor Dad back in 2001. Through the past 2 decades, I've just learned more and more strategies. I took the ninja, the Cashflow Ninja. I took the martial arts approach to it, where my goal was to pursue mastery in my daily craft as an investor every single day and try to get better every single day at it. And we still do. In 2015, I created, as you mentioned, Producers Wealth virtual firm that actually helps a lot of our clients, which is in over 50 states, and we're adding a territory right now, but that helps our clients implement some of these strategies, which one core strategy is the infinite banking concept. And then I'm the creator and host of the Cashflow Ninja podcast, which is now grown into a full-blown education company globally. We've been very privileged to reach listeners in over 180 countries. And we continue to do so. We've cranked out over 600 episodes, and we've been very, very blessed to reach so many people. And we're now turning it into a full-blown educational company, trying to provide as much value as we can globally to folks.
You learned from the Purple Bank and you took those concepts and then you utilize different tools to be able to take advantage of different things. Like you said, you studied the wealthy, right? But also you work with a lot of real estate investors, passive investors who utilize these tools. Can you dive into how you are educating them with the infinite banking concepts?
Yeah, the big thing for investors is, and the one thing that's very, very important for investors specifically, and I didn't know this, trust me, I learned from making mistakes, right? And then now, as I'm getting older, I'm in my early 40s, I try to learn from other people's mistakes because I'm kind of running out of time with all the mistakes that I've made. But anyway, needless to say, learning from mistakes, one of the biggest mistakes that I had as a real estate investor is I really never positioned capital efficiently and effectively. And what I mean by that is I had properties, and as with real estate properties and things go, what happens? People don't pay rent, things break, and so forth. So there needs to be capital to fall back on for that. And where the capital is very, very important. Like, for example, if real estate investors have a bunch of capital tied up, let's just say in their properties, and they all of a sudden need access to it, guess what? It's really difficult, as they found out in 2008 and 2009, and it could be really difficult again. So you might be thinking, oh, I've got some money in the bank, but I've got a lot of equity in my rental properties. Well, guess what? They might pull HELOCs again, the way this is going already in the recession that we're about to go in. And there's already banks that have discontinued those products and said we are no longer offering home equity line of credit. So if you use the HELOC strategy, which is also a very good and powerful strategy, you're running out of you're basically running out of that option. So where else do you position capital besides a bank that you can access it whenever you need for emergencies, and also position it effectively that it does many different things for you, right? So there's a number of places that you can put it. I showed you could put it in stock portfolios, right? There's a strategy called asset-based lending, which allows you to borrow against stocks, a certain stock portfolio. Some investment banks have them, and then leverage that to go take the loan, which is secured by the stocks, to go invest in real estate. That's how you can actually use equities to buy real estate. It's not a strategy I endorse for many, many different reasons. Markets can be volatile. It's not guaranteed. It doesn't go up. Your growth isn't growing tax-free. So you're at the whims of a lot of unknown variables, which you don't necessarily control, right? So that's the first thing. The second thing is, I covered HELOCs. Then, folks store money in gold and silver and other commodities, which is great. And by the way, through commodity-backed finance, you can actually leverage gold, silver, art, other commodities and borrow against it, get a loan secured by it to buy real estate. It's a strategy that I've used personally. There is companies that allow you to do that. So that's how you can use your gold to go and buy real estate. Let's just say that, right? Again, a lot of things there you might necessarily, like one of the companies, they only allow you to get about 62.5% of the value of your gold. And I don't have any control over gold and silver. And there's 3 different types of markets, which is all manipulated, whether it's the actual physical market, whether it's the futures, whether it's the ETFs, the paper market. So I don't necessarily, again, I don't have a lot of control over that. You could also, by the way, do this with crypto. There's now companies that hold Bitcoin as collateral that then gives you loans to do that. Again, not something that I endorse nor tell people to explore, because it's extremely volatile. And by the way, you might get margin calls the same way that you get in stocks, right? So the other thing that I also look at is business, which you have more control over, more of a strategy that's more in line. For example, you can use the receivables of a business and the assets of the business to secure loans, which you then can use for real estate. We have someone in our network that use the receivables and the assets of the business to collateralize the loan and use the loan to buy the real estate from which the business operates. Use one asset to acquire another. But infinite banking uses an overfunded whole life insurance policy. And people would say, whole life insurance, are you kidding me? Yes. If you can compare a very well-structured, overfunded whole life insurance policy, and it's life insurance, not death insurance. So it's a savings element and vehicle where you can position capital where the money's guaranteed, it's growing guaranteed. So your principal's guaranteed, the money's growing guaranteed. You get access to participate in the profitability through sort of a rev share mechanism of the mutual insurance company, which is owned by the policyholders. It's called dividends. So you get access to dividends with these companies. It's not guaranteed, but they've been paying them out consecutively since the mid-1800s. The growth is tax-free. The dividends are tax-free. The policy loans, which is sort of a credit a credit line secured by the cash value of your policy. That's not taxed as income distribution. That's tax-free. There's a death benefit that goes tax-free to your beneficiaries. It's a private contract. It's, when you look at all these things, you go, well, it's no wonder that the wealthiest families in the United States and Canada position capital inside of family offices, inside these vehicles, because it just checks all of the boxes of having control, having access to it when you need it most, and having $1 doing so many different things for you. Now, and your listeners that are real estate investors know how many things real estate can do for you, right? Dollars invested in real estate can do multiple things simultaneously, and it's very, very effective when it comes to taxes. Now, combine these two, and now you're just supercharging what you are already doing. So, one person in our network, just by positioning capital more efficiently and combining his real estate investments with this, he wasn't changing anything with his real estate strategy. But over the course of 20 years, he would have access to about $1.46 million tax-free, more money in capital, just because he positioned it more effectively and efficiently in that space of 20 years. So another thing that I also share, like, how do we help real estate investors with it? Real estate investors understand cash flow, which is what we talk about all the time. But if you really understand and look at the assets and how it's structured, you'll start to realize a couple of things. And this was big for me. This is when it was sort of like I fell off my chair when I kind of geeked out on this and really got into this. But real estate, the asset class, and life insurance, the way that we do it, is essentially the same asset classes. And people would look at me and say, "What are you talking about? You're out of your mind. You're losing it." Well, think about it. Here's some food for thought, as they say. Number one, with real estate, you have a mortgage, right, that you pay. Let's just say you get a loan, you make payments towards a mortgage for a certain period of time, and then after you've made those mortgage payments, you own the property free and clear. The same thing with the life insurance policy. You make payments into the life insurance policy for a specific period of time that can be negotiated the same as a mortgage. There's certain terms, and then you own the policy free and clear. Now, with real estate, when you make mortgage payments, you pay principal and interest. And what happens when you do that? Well, you start to build equity into the property. The same thing with a life insurance contract. When you pay premiums, which a portion of it goes towards the insurance, a portion goes towards the savings vehicle, you build equity in the policy, and you build it, by the way, very, very quickly, the way that if it's structured correctly. Then the next thing that you look at is appreciation. If real estate investing is done right, the property appreciates, right? Every single year, operations get better, property appreciates. The same thing with life insurance. If the contract is structured correctly, every single year, your cash values are guaranteed. You build up more equity in it, but also your death benefit increases. So the value of the contract increases. Now, how do people access money in a property that you just bought, right? The equity. Well, you do it through a home equity line of credit, HELOC, which is the equity provides collateral. You get a credit line against it. It's interest only. It's paid. The same thing with a life insurance contract. You access the equity in the contract through a policy loan, which acts as a credit line, which your cash value is placed as security, right, as collateral. And then other things, if you look at the cash flow, let's talk about cash flow. With real estate, the first time, my first property that I had in 2001, when all of the expenses were paid and after the rent was paid, at the end of the month, I had cash flow left. That's why we love real estate. The same thing with life insurance. You know, when the insurance company, of which you are a shareholder, pays all of the bills, at the end of the year, the profits is distributed to the policy holders, cash flow through dividends. Now, is cash flow on a real estate property guaranteed? No. There's a lot of variables. Is it guaranteed in a life insurance contract? No, but if it's done correctly and it's with the right operator and it's with the right carrier, then yes, with a great track record, then the chances of the probability is very good that that's going to continue to happen. The other thing that's very, very interesting about this too, and I mean, I could go on and on. There's two more things, is that actually there's two
Keep going with it. Keep going.
two institutions that love to borrow or lend money to purchase both real estate and life insurance. And people are like, what are you talking about? Banks. Banks love to lend money on real estate because of the strong collateral behind it, right? And the strong asset class. They do the same thing with life insurance. It's called premium financing. So there's actually financial institutions that will lend you money to purchase certain types of life insurance. And it's, again, the net worth, you have to be, over $10 million of net worth for these individuals. There's financial institutions who will actually lend you the money to go and purchase this type of specific life insurance that I'm talking about. The other thing, which is also very interesting, is when you look at real estate, people know about notes, right? We have phenomenal notes, real estate note guys in my network. Great friends over here too. They love real estate notes. What is real estate notes? Well, it's essentially the mortgages that's being packaged and sold and traded and sold, right? Most banks, when they have a mortgage, are not necessarily the holders of that mortgage after they set it up for you. They sell it. You can actually sell the mortgages on a different market. The same thing with life insurance, believe it or not. There's an asset class called life settlements. And it's actually, you can legally sell life insurance policies that you have. Why would people do it? Well, because they're in financial difficulty. They didn't have savings. Like a good example is during 2008, 2009, people lost all the equity in their houses. They lost their money in the markets. And guess what? The only asset they had left was a life insurance policy with some cash value, which they could sell it to 4 to 5 times the cash value of that. A lot of folks are not familiar with that. Here's a last one to end off with a fun one. If you look at the tax, how the tax code is structured, in real estate, you have a 1031. In life insurance, you have a 1035. If you look at it, the two asset classes side by side, you will fall off your chair of how similar they are and how similarly structured they are and the benefits that they have. And also, the tax benefits that I'd even touch on. Your listeners, real estate investors, know this stuff, that the tax benefits of real estate, you could do a whole episode just on that. The same thing with life insurance, where it's after tax money. So you don't get necessarily a tax deduction when you put money in there, like a 401k or a Roth, but you pay taxes on the seed, not the harvest. So the money that's inside of the vehicle is growing tax-free. The dividends are tax-free. You can access the money tax-free, and the death benefit is distributed tax-free. So two very, very powerful asset classes. One is just a property, an actual physical thing, and the other one is a human being. That's the collateral for the asset.
I love that. And ladies and gentlemen, if you didn't get that from the beginning, when he said he studied what the wealth does, I think that just showcased everything right there. Thank you for breaking that down. It's a lot of parallels with real estate investing, with the whole banking policy, with the infinite banking concept models that you just explained. Now, as an investor, how do I prepare myself to utilize one of these infinite banking tools?
Yeah, it's a great question. So as an investor, so there's a couple of building blocks, right? So most of our investors already they start at ground zero. They invest in themselves, their mindset, their skill sets, their capabilities, their networks, their relationships, and so forth. So they already have that part down. The first part is you have to set up liquidity. And, here's another thing that I will tell your listeners too. Look at what billionaires and very wealthy people do, not what they say or how it's spun in media. Because if you would go to Warren Buffett and say, I have $10,000 to invest, what should I do with it? You're not going to put that in an ETF or John Bogle's Vanguard fund, right? Because, by the way, none of those guys diversified. Just a little fun fact there. They're both business owners, and they invest in and they focus where their strengths are. So, they're not diversified. Later on, maybe in a couple of industries, I know Buffett is tipping his toe in many other industries, which he's never done before. But where they really made their money, which drove the needle big time, was focusing and sticking around their strengths and so forth. And the reason why I'm rambling on and ranting about that is they also know the power of liquidity. So if you would, if they had $10,000, I can tell you right now, Bezos, Buffett, all these guys, if they had $10,000, they would be investing in themselves and they would build liquidity because they understand the power of liquidity. You want to know how powerful Buffett thinks liquidity it can be? Look at his position right now. Look at his position pre-COVID. They were sitting on the biggest pile of cash that Berkshire Hathaway's ever sat on before. So they understand. So, and that's a hard lesson I learned, by the way, too, because I at one stage had some assets and properties, but I wasn't liquid. I didn't have any liquidity. So build up your liquidity pile. That's where you start. And you build it up where you have a minimum of 6 months of living expenses, business expenses, and your real estate expenses at all times. And that's the floor. And by the way, and then you try to ramp it up to 12 months, which we told a lot of the folks in our network to do at the end of last year. Not that we predicted a pandemic, but we kind of saw the shenanigans that was going on in financial markets. In September, October of last year, a lot of folks didn't realize because it wasn't big time in the news, but there was a lot of things happening in the shadow banking system, which is the repo markets with the Federal Reserve. It was technically basically a bailout happening in September, October last year. So we try to rev up, again, cash reserves to position ourselves. So when you have 6 to 12 months of cash reserves, the second part for real estate investors is efficiencies. Now, once you have that built up, now you can look at all the other areas that you are inefficient in that can produce a ton of savings over the course of 12 months. And what do you do with that money? You put that back in liquidity. So what do I mean by that? Here's some examples. What are some of the things, cash flow leaks, low-hanging fruit that a lot of folks have? Well, maybe there's big ticket items for entrepreneurs and investors for health insurance, right? For disability insurance, if you're a professional, for all these types of insurances. So if you have 6 to 12 months of liquidity, you can raise deductibles. So for health insurance, by the way, folks in our networks and personally, we've saved thousands of dollars by raising deductibles because we have 12 months, a fund of 12 months of expenses in liquidity. The same thing with disability, the same thing with property and casualty, all these different types of insurances. Disability, you could raise the time deductible, by the way, to 180 days, which is 6 months. So it saves you thousands of dollars over the course of years, right? And where does it go? It's not like you're spending that. You have a plan for it. It's going back into your system, which is either in specifically structured bank accounts, which you could separate, or your infinite banking system into the whole life policies, because that's where you warehouse your capital now. And then the third piece of it, I would also say, is having a proper tax strategy in place, having a proper asset protection in place, and then estate planning, which is very, very powerful. A lot of us think about succession plans for our business or our properties, our rental properties. But if you're going to run your financial life as a business, which all of these very wealthy, ultra wealthy cash flow ninjas do, you should do the same thing. So we talk about a family constitution. We talk about comprehensive planning, all of these different things that happen in family offices. And I always joke and say, when I talk about family offices, the first response is folks go, MC, I don't have $100 million, so that doesn't really apply to me. It's like, no, you don't have to be David Rockefeller or the Rockefeller family or Bill Gates, Warren Buffett, Jeff Bezos, any of these guys to do what they do on a very small scale. A family constitution doesn't cost you any money, by the way. All you need is a notepad and a pen and a block off some time, as you would for your business or your work, with your family to have conversations around money, what's important, your belief, what you stand for, what you stand against, what's your investment philosophy, how do you view money? It's a very important question to ask, by the way, no, if you're going to try and build wealth. Because if you have bad attachments and connotations to money, which a lot of people have, which is why they don't talk about it, quite frankly, because a lot of people don't talk about money growing up. I didn't. My family, we didn't talk about money. So having these discussions already, you've started to empower your family and you've documented, you could put it in a Word document, and that didn't cost you a single cent. But that's what very wealthy families do. So let's just recap of some of the stuff that I mentioned. So the ground floor skill sets, your mindset, and your mental and intellectual capital, developing that, your relationship capital, your networks, and then also your skill sets and capabilities. Then set up liquidity, build up liquidity, then look at inefficiencies, cash flow leaks, plug it, and put more of that money into liquidity, and then have a proper tax strategy, asset protection, and estate plan in place. And now the fun part starts. This is all the stuff underneath the iceberg, right? The water. The stuff, by the way, that I mentioned now, it's not great cocktail party conversation. It's not sexy. It doesn't excite people. The stuff that excites people is the next kind of steps in finding the properties, the deals, the markets, all these other things, which is the fun stuff to talk about. But once you have this stuff in place, it becomes pretty powerful, because think about it. Imagine now you try your first real estate deal and it blows up, which, by the way, there's a chance it could happen. My first one didn't blow up, but my second and my third one did. So what happens if that happens? Well, now you have still liquidity to fall back onto. You're efficiently structured with capital flows inside of your personal and investment economy, and you still have all the other building blocks in place. So the house of cards doesn't come down. I think what a lot of folks focus on, because this is how we've been marketed to and how we've been brainwashed, for a lack of a better word, is just focusing on the sexy stuff. Most people save 10%. That's all they do. They focus on that 10% and try to double it. Well, if you focus on the full 100% and make sure that you're efficiently positioned and structured and set up properly, it's just going to go so much further along in the big scale of things.
MC, thanks for sharing, man, because years ago, I visited with a financial advisor, and he told me, I thought I was going to walk in with a plan more of investing, but I walked out with basically what you described, that first level. He said, build your foundation. And that's exactly what you explained. So I went back to the drawing board and I did just that. That's powerful, because when you build that foundation, it just sets you up. It's beneath the iceberg, right? It's that big layer of ice that's supporting that underneath it. And now you said the sexy stuff starts to happen up top, right? Can you dive into those sexy things a little bit?
Yeah, absolutely. So the sexy stuff is what you were just saying too, is most financial professionals don't get paid for setting up foundations, right? You're the asset, you should be investing in that, relationships or assets, and then liquidity, positioning that, making sure you're efficient, and then getting the other stuff set up. So most of them, that doesn't fall into the realm. Where they make their money is assets under management. So it's stocks, bonds, and mutual funds. Let me get you a Baskin Robbins flavors of all these funds, and I'm going to tell you the rate of return that you're going to get over that, because I'm going to show you all of these great projections on a spreadsheet, which every single one of those presentations should start with once upon a time. Once upon a time, this fairy tale could have potentially not happened to you. And then they're going to tell you about the rate of return, which every single person is so fixated on and marketed to. I'll give you an example. So the rate on return is one thing. So let's just say you put, which, by the way, you can torture that data too. I'm not even going to talk about average rate of return, because it's like I've my one hand in boiling hot water and I've got my other hand in the freezer. But my body temperature is okay. That's the average rate of return. Some years it's fallen 40%, other years, it's up like 15, 20%. But average returns around 8% per year, which is there's so many holes in that story. It's not, I could do a podcast episode on that, by the way. So they're going to sell to you with average rate of return and rate of return. But it's like, so I look at this and go, as you should with any investment, also real estate, because there's different positions in real estate, different types of investment. Maybe there's a debt deal, maybe there's an equity deal, and so forth, is when you look at a deal, you go, okay, how does this, besides all the other things that you should have in place, the operator, the team, the management, their track record, are interests aligned, the way that this deal is structured, how is it financed, and of course, what even comes before that is the market, the asset class, all that stuff. Okay, let's talk about numbers here, the sexy stuff. If you look at the rate of return that's presented to you, what's the tax implication of that? And most people are, what do you mean? Oh, you got to pay taxes somehow. Taxes is out there. What is the implication on that rate of return? Where does it fit in? Is it a debt deal? Is it an equity deal? How is it positioned? Like, how does it look on a tax return? And I think that's one of the golden rules which folks don't look at, because the tax code is the rules of the game. So if you're saying, hey, I've got this great move, this football move for Tom Brady, and we're going to block this, and we're going to throw this, and we're going to double this, and we're going to fake this way. And I'm like, that's great. Is it legal? Is it in the rules? How does it play out? Yeah, he's going to score the touchdown. Is there like, how many flags? All the flags going to be thrown simultaneously, and it's going to come back. So the same thing with the rate of return is like, all right, that's great. I could see you. I hear you. Great. Rate of return. How does it look in the tax game? Because that's how very wealthy people look at it. So there's some deals that are phenomenal because not only does it have a great return, yes, which keeps up with inflation and so forth, great cash flow fits into that dynamic, but it's also very, very efficient from a tax standpoint. When we talk about strategy, which that's the core, I would say, message for folks, have a strategy. Don't have a plan, Everybody's got a plan until you get punched in the face. So on a strategy, when you think strategy, here's a couple of questions to ask. What do you have? Why do you have it? And what do you want it to do for you? So with the sexy stuff, when it comes to businesses that cash flow, real estate investments that cash flow, maybe there's growth strategies. I mentioned life settlement investment, which is a phenomenal asset class for growth, not for cash flow, very illiquid. Again, why do you have life settlements? Why do you have it? Well, it's a great growth play. It's non-correlated to markets. What do you want it to do? It's not liquid, by the way. It doesn't produce cash flow. What do you want it to do for you? I want it to grow my capital 10 to 12% approximately, and every 5 to 7 years have that return and then keep rolling it over. That's why you have it. That's what you want it to do for you. Why do you have real estate? Produces cash flow. Every month, there's cash flow coming in. Great tax advantages, great tax flow. Why do you invest in oil and gas and other energy products? Why are you investing in that? What do you want? What do you want it to do for you? Well, a lot of folks invest in it because they have tax problems. And what I mean by that, there's some deals out there where there's 100% bonus depreciation on certain energy deals in year one. So if you're a top earner in the country, and just on a federal level, you could potentially look at, on a $100,000 investment, of knocking out $37,000 off your taxes, right? That's why you do it. And then also the cash flow. So then I go to the ultra speculative stuff, very sexy stuff, the stocks. Why do you have it? What do you want it to do for you? You have a 401k. Why do you have a 401k? What do you want the 401k to do for you? How does a 401k look from a tax strategy standpoint? I know the answer. I think it's one of the worst things you can do, anyone can do out there from a tax strategy standpoint, but you got suckered into it because the financial planner at your company, which is an HR person, set it up for you, or everyone else did it. That's why you did it. And that's what people told you what to do. And that's why you max it out. You lose all the control. You lose in the tax game because you're deferring taxes. So you're not going to pay taxes on the seed. You're actually going to pay taxes on the harvest. Gave up all of the control. You put up all the capital. You carry all of the risk, and the fees are collected by financial companies. So when you look at all that stuff, the quality of our life in general is determined by the quality of our questions that we ask ourselves and the quality of our thinking. And if we don't ask ourselves good quality questions every day, and we don't challenge our own thinking, I do it every single day. You don't want to be in my head. It's nuts in here. It's nuts. It gets crazy. I ask myself very tough questions every single day. So that's what I would say with the speculative stuff. And yes, there's a time and a place for everything. Like people would ask me about precious metals. It's wealth insurance. Again, I look at the gold and silver as wealth insurance. It's something that someone should have in place, right? In case of a worst case scenario or currency, issue and so forth. There's some great businesses that one can invest in. There's some great real estate assets that one can invest in. And eventually there are some great companies that you could invest in once you get to a certain level. I mean, and the cryptos kind of falls into that too, where why would someone even look at it? Why do you have it? What do you want to do for it? Paul Tudor Jones, one of the greatest traders in Wall Street history, just moved, I think earlier this year, 2% of his net worth into Bitcoin, for example. So why did he do it? Why does he have it? So he was saying that because of, again, just insurance, it's very volatile, it's a small piece, but from an insurance standpoint, he feels that with all the money printing and the bailouts, he needed additional insurance to his commodity positions, his gold and his silver. So he puts it in there because there's a limited and fixed amount, for example, on Bitcoin. That's why he did it. So he's asking himself these questions. Where do I put it? What is it? What do I want it to do for me? And also, how can he manage the risk? So that's what I would say with the very speculative and sexy stuff is, we like to have control. These very wealthy folks all have control over their money. They have control over investments. And even if they're invested as let's just say, as a limited partner in a real estate deal, they still have access to a operator, right? And to a sponsor, to answer questions, to know what's going on. You and I, John, we don't sit at the table at the Apple boardroom. Although he's also from South Africa, I can't pick up the phone and call Elon Musk and say, Elon, can I sit at the Tesla, in on this meeting? No. So we don't have a lot of control over that. We have a lot of control over other things that we have options to, right?
Absolutely. I mean, you hit on a lot of things that really resonated with me. For instance, we could definitely bring you back and have a roundtable discussion just off taxes and rate of return alone, right? But the biggest thing is reverse engineering it, understanding the playbook that you mentioned. As a basketball referee, I started refereeing at the age of 35, right? So I said to myself, when I realized the rules, if I read these rules when I was younger, I'd be a better basketball player than I was. And It's just because I understood the rules, what I could do and what I couldn't do. So understanding the financial game on that same level is understanding the playbook, having a great accountant to help you understand it, or just someone that just on your team that understands that playbook. And I ask a lot of questions to my accountant. What's this? What's that with this? How can I do this? How can I leverage that? And the rate of return numbers and IRR and whatever you want to inflate or whatever you want to go off of really dictates on how it is basically affected by the taxes, because it could say 30% IRR, but half of it's eaten up by the taxes at the end of the day. So what's it really mean? So understand what you can do. Thanks for breaking that down, MC, man. Really love that. Can you give us one piece of advice for the PI listeners?
Yeah, I would say that the greatest asset that you will ever have is yourself, right? And I think sometimes we forget that, especially in this year and in the coming years, in what I believe we're already in a major recession, could be a depression. The folks that develop their most important asset, which is themselves, are the folks that are going to win this next 5 to 10 years in relationships. So investing in yourself as the number one asset and investing in relationships, between those two, this is what's going to get you through tough times. This is what is going to make the good times even better. And again, I just reverse engineered what a lot of really successful people do. You've seen this many times where billionaires lose everything, like literally everything, bankruptcy, divorce. I mean, they are rock bottom, down and out. And within a couple of years, they're back. and they've started new companies and built new things and created all these jobs, and you're looking at them going like, how is this possible? How did that person go through all of that and then came back even stronger than what they were before? It's because they never lost sight that they were the asset to begin with, and then how important their relationships were. So by investing in those two, I think it's going to help you through what I believe we're in already and what's coming down the road. And it's also, when things get better, and if I'm wrong, it's just going to make the good times even better.
Absolutely. Absolutely. MC, how can we stay in touch with you?
Cashflowninja.com is where all of our information is, our content. There's over 600 podcasts on there, but there's also webinars, courses, like, for example, the Infinite Banking course, which is at yourownbankingsystem.com. You can find that at cashflowninja.com too. But everything regarding our community and what we're a part of, what we're building, and in the process of building, will be there if folks want to follow us and just see all the interesting stuff that we're up to.
I love it. And my favorite question is there any meaning behind your company name?
Yes. So Cashflow Ninja is, so Cashflow obviously was the biggest aha moment that I had of how to change the philosophical approach to wealth creation and building, and focusing on cash flow and energy flows instead of just accumulating and hoarding like we're told. And then Ninja, so my dad is actually a very famous martial artist. And what I saw from my dad, he travels about 7 to 8 countries a year. He's been doing martial arts for over 50 years. And what I saw firsthand with my dad is that the pursuit of mastery in his craft daily. I mean, he's in his early 70s and he is still pursuing mastery. And that's what the greats do in every facet of their life. So I kind of took that, brought the ninja in with cash flow to make that sort of the central thing of what we're doing. Is we don't arrive at knowledge. We don't know everything. I'm just learning every day and trying to pursue mastery in my craft and learn and grow every single day. So that's where the Cashflow Ninja comes from. And Producers Wealth, my wealth firm, where that name comes from is I'm a huge fan of the book Atlas Shrugged, and a profound impact on me. The money speech by one of the characters in that book is one of the greatest pieces of literature I think put out for a very long time, just explaining what money is. And the book is all about being a producer and a creator versus just a consumer. So that's why I chose Producers Wealth. So Cashflow Ninja, the pursuit of mastery, and Producers Wealth, being a producer and a creator and not just a consumer.
Guys, if you want to learn more about and dive into the infinite banking strategies and just anything else, because you've seen it here, you've heard it here, how much he knows and studies about financing, I advise you to reach out to MC. Just if you ain't already a Cashflow Ninja listener like I am, go and listen. Thank you for coming on, MC.
Thank you so much for having me. This is a lot of fun. Appreciate you, my friend.
I appreciate you. Don't forget to download your free copy of the investment tracker. It allows you to track up to 5 investments, compare sponsors, markets, and most importantly, projected versus actual returns. To get your copy, go to www.projectedreturns.com. PI listeners, thank you for listening. As always, we hope this was the best resource for your investment strategy, but also the best use of your time. Remember, if this episode helps you, you can help us by leaving a review on iTunes. I hope you feel compelled enough to share it with someone you think this would resonate with as well. As much as it pains us to leave you, but you know what time it is. Time to go put this into practice. Till the next time we meet, happy investing. PI listeners, I'm grateful for your time and I appreciate you for listening. It would mean the world to me if you went to iTunes and left a rating and written review. Let me know how you feel about the show. It really makes a big difference with getting the podcast out there. Don't forget about our Facebook group, where all of our guests are members of. I'll be there to answer any of your questions, or even questions you might have for future guests. Subscribe so you can get the latest episodes and our fan favorite quick hitters. Finally, I want to keep you updated, so head over to johnfortes.com and sign up for the newsletter. If you're interested in partnering with me, sign up on the contact page so you can talk to me directly. I look forward to connecting with you. Happy investing.